Hope I'm audible. So we can start with the webinar today. So thank you all for joining on a Saturday morning. So quick introduction about myself too. I am Vinayak Kumar. I am financial planner at ithought, and most of my days of work looks like where we do map or let's say holistic financial planning for investors. And but somehow we help our investors map their financial goal towards the investment so that they are more serious about what milestone that they are working towards. So we are going to start, let's say, this today's webinar or session, and in this, it's going to be more simple about. There are a few things that you already would be thinking about. Of let's say, for example, if my investments are doing good or not, are we able to let's say achieve the returns that is expected? And let's be honest, most of us feel the same way at some point. The issue may not be the market; it could be our own strategy that we're actually working on, or if it is not working out in a way. So I'm going to put this entire webinar presentation in three acts. So act one, what we are doing wrong, the five most common mistakes that quietly drag the entire portfolio down. Act two, what you already have working against you, wrong assumptions and hidden gaps in things you thought were already being taken care of. Act three is going to be how to plan properly, a simple four-step framework you can actually use on one ground rule. Let's say, for example, if you have any questions at any point of this webinar, just let's say, for example, don't wait for the end of it. You can directly drop it in the chat box and we will catch up in the end and discuss the same. So to start with the act one, let's say, for example, what we are doing wrong. Five mistakes. They are hidden because they don't feel like mistakes when you're making them, but they feel like, let's say, for example, a prudence like research, conviction, and very small things that actually add up on being a very big mistake in the overall long investment journey of yours. But over 10, 15, and 20 years is what I would say. So this is going to be, let's say, the costliest mistake that might actually cost you fortune. And let's look at the first three in the upcoming slide. So as a financial planner, this is going to be, let's say, the first topic that I'll be talking about. Mistake one, no clear goals. Most portfolios are built across, or let's say, around products, not outcomes. Someone shows you a great fund, you invest in that. Someone shows you a tax saving plan, you invest in the same. But ask yourself, what is this money actually for? By when, how much do I need to accumulate in that specific fund or mutual fund portfolio? If you can't answer that in one sentence, your portfolio is essentially a collection of products and with no goal or let's say with no end target. So in that case, mistake two is going to be part of it. It's going to be poor asset allocation. So here's a stat that surprises everyone. 90% of your long-term wealth return variation comes from your asset portfolio mix. That is going to be equity versus debt versus commodity, not from the fund or product that you've fixed or let's say picked. And yet, where do most investors spend their effort picking funds? We obsess over the cost and ignore the play of, let's say, long-term investment creation from a proper asset mix or a proper asset allocation. Mistake three is going to be chasing top performer. So I'll give you an example about myself. I actually started investing 6 years back. I went to grow and put a filter of top performer in that specific year and started investing in that same. But actually, that investment, let's say, for example, idea or decision making by seeing the top performer might not be a great one because what has actually done great might start being saturated over a period of time. So hence, what has done well might not actually continue for a long period of time because everything works as a cycle, right? What goes up eventually comes down, and that is the right time where we have to invest in and tap in. So best fund of the last year is one of the most expensive pipelines financed. So less than 25% last year's top, let's say quartile funds, say top quartile for the next year also. So think about that. So you're buying high, selling low, and calling it, let's say, for example, research generally. So that is something that is an analytical mistake that we actually work on. So hence, investing in just a top performing fund, expecting it to further do great in over a period of next 2 years, 3 years, might not actually work out in our way. So next slide is going to be the most expensive ones. So mistake four, emotional and exits. So as we keep on review a lot of portfolios in mutual funds, stock equities, we always see, let's say, a lot of emotional attachment to a specific stock or a fund. Let's say I invested in this fund almost 10 years back, and there's an emotional attachment to it. Initially, let's say a land or a physical gold or jewelry, right? When we buy it as a physical asset, it's very hard because there's emotional attachment attached, not just us, but also entire families. But nowadays we see for stock and mutual fund also there is going to be a lot of emotional attachment to the same thing. And that is actually a very big mistake that we generally see in current investment behavior in a lot of investors that actually be part of our journey. Next is going to be the concentration disguised as conviction. This one is actually very interesting because people come with three different large cap funds and say that I'm diversified. So actually, you are not. You own three wrappers around the same trade. Real diversification spans from asset classes, geographies, market caps, investment styles specifically. Let's say we also would have investments in two different large caps, but the styles would be completely different. One would be a growth style, or a second would be a value style of investment approach. So not just three different fund houses doing the same thing is what we look for. So here's the question. If behavioral cost more than the allocation, why does nobody talk about it, right? So let me show you what it actually cost, specifically with real numbers in the next slide. So staying the course. So let's say, for example, right now, a lot of investors would have a lot of worries with the current market context due to the Iran-Israel war and so on. Some interesting data that I actually prepared almost 2-3 weeks back. So same starting capital, let's say, for example, same market, same 5-year period, January 2020 through the COVID crash and the recovery. Four investors, there are four different unique cases, and that is something that will give you some insight. So here, one assumption that I'm taking is each of these people are starting with 1 crore. Okay, so just to see that investor one holds steady. Let's say, for example, he started at the 1 crore at January 2020, right before the peak before the COVID. And after that, let's say he was very panicked and he didn't actually sell out anything, but he also didn't further scale up in the market. So in this case, what was his performance? It was approximately 10.5% annum, that is compounded growth rate over a period of last 5-6 years, and he accumulated a group corpus of 1.8 crores. Second is, let's say, for example, investor who started with 1 crore at the same time. But what happened is there were three major corrections in, let's say, COVID. Obviously, we won't be able to predict, let's say, what is the high and let's say what is the low during any market cycle. But let's assume that he participated and topped up 10 lakhs each at every market correction that was there. That was March, April, May 2020 at the lowest point during the COVID cycles. So in that case, just by adding 30 lakhs, his entire portfolio corpus was grown into, let's say, for example, 2.6 crores. That is 12% compounded growth rate just by investing 1.3 crores corpus. So that's actually a really great strategy, right? So third, he waited for safe, let's say. So he started with the same 1 crore capital. He waited for, let's say, for example, new all-time highs before deploying the 10 lakhs. That would be October, November, and December 2020. So in that case, what happened is he didn't try to invest at the market correction, but whenever market started picking up from that any dip or drawdown point, he's the same. In that case too, he has done really great. Just with the investment of 1.3 crores, he had built a good corpus of 2.3 crores over a period of last 5 to 6 years. Last was the panic seller we actually faced at a lot of times. So in this case, he started with a capital of 1 crore, but at every correction of March, April, and May 2020, he did redeem 10 lakhs just with panic and fear, expecting that it's going to be different and markets are going to be correcting. So every time there's going to be a market correction or some volatility in the market, people have the judgment that, okay, this time is different and we need to safeguard the capital and it might not bounce back and so on. So hence, at that case, see what the cost for the entire behavior has been. So 7% per annum was return for that last investor who actually panic sold and then invested or let's say entered back when market started recovering in late 2020s. So in this example, just one perspective that we wanted to give is, let's say, even at the market panic, or let's say, for example, if volatility is there, if you are able to, let's say, contribute and further scale up, you are gonna end up, let's say, averaging out your, let's say, risk and stocks over a long time. Let's say, for example, okay, you have already committed the entire capital that you have and you don't have anything to scale. And if you just hold steady too, you're gonna do really great over a long period of time. But that doesn't mean that you are allocated in the wrong part of the market and you expect to do really great. So if an investment advisor is also involved, it's going to be a good win-win strategy for both of you. So these are the few mistakes that we actually saw. And okay, let's say, for example, we'll be going for the next, let's say, slide. That is what you already have against, let's say, working against you. This is a harder one to spot because it's not about what you're doing wrong. It's about what you've already done and assumed was fine, or let's say it would actually work out in your favor. So things, let's say, for example, that you already see plenty of times when we do financial planning or review exercise for investors is high returns equals to better fund. So actually, this is going to be completely false. No risk-adjusted returns would actually matter more compared to a higher risk, high return fund. So a fund that actually gave 5%, or let's say, sorry, example, 18% by taking on dangerous concentration isn't better than a 14% fund with sensible risk. So especially when you have to live through the entire volatility. Second, for example, assumption that we actually face is my EPF and LIC equals my retirement covered. So this is something that we generally see very often. People assume that, let's say, for example, what they have been contributing for 20 years, they are set for the lifetime with the EPF and LIC corpus that they actually built. So have you actually run the math? Most LIC policies barely beat inflation. EPF alone for most people won't fund a 30-year retirement plan also. So it can be a good corpus for your entire retirement. That would be, let's say, 25 to 30% of your entire portfolio mix for your retirement. But that cannot sustain for 25 years or 30 years, assuming a, let's say, higher lifestyle expense or current inflation growth rate. So one thing would be is generally, this was also one assumption that I had when I started working out. I'll invest more later when my income grows. So time in the markets beats timing your salary hike. The 10,000 you invest at 30 does more work than the 50,000 you would invest at 35 or 45. So why I would say that, let's say, for example, starting is going to be much great because at, let's say, 100 rupees salary, if you're able to invest, let's say, at least 20 or 30 rupees of that, you're actually not building or, let's say, creating a lot of big capital, but you are setting the right investment behavior for you so that when your income grows from 100 to 1,000, you will still stick to the 20 or 30%, let's say, contribution. So that is going to be the important part, but not just the capital. In the right investment behavior seed in the scratch of, let's say, when you begin investing in your journey. So next would be is real estate. Real estate is the safest investment. So recently in my family friend too, I had actually asked the query about in your retirement, what you're going to tap for your entire monthly expenses or monthly flow. For them, they said that real estate is what they're going to take care of the entire monthly income during the retirement. I asked if you had an emergency expense or medical expense, are you going to be able to sell a part of that real estate property? The answer was no. So one thing is it's actually very illiquid and lumpy and hard to truly diversify. And most people massively underestimate opportunity cost that real estate brings also. So now let me actually show you the another two biggest gaps that we generally find in most of our investors. So most people in this room are insured, but most people in this room aren't well covered because most of us would have employee sponsored health insurance plan. But do you think it is sufficient? Actually, might not be. Let's say, for example, if you're in a transition phase, moving from one job to second job, and that time, let's say if you are unexpectedly hit with a medical bill. So in that case, you won't be left with any medical cover. Let's say a few of us would already say that, okay, let's say right now I'm with my company, I have a company sponsored medical cover. Let's say after when I leave this company, I'll actually take a separate health insurance plan. That would be an assumption too. But you should also know that when you take a new policy, there would be a 3 years waiting period to actually start claiming bills from the health insurance. So in that case, to simply put, at least bare minimum, you need to have 5 to 10 lakhs per head in your entire family as a cover. Let's say if you're a family of 4 with your wife and 2 kids, then bare minimum 20 lakhs coverage is what you should look for. Because one medical bill can actually derail the entire emergency or let's say portfolio that you've built over a long period of time. So other important thing is if you are, let's say, a salaried person or if you're dependent at home, which are dependent on your monthly income or salary, then you should have a good term insurance cover also. Because most of us already see insurance as something that we need to expect out of it after a long period of time, right? But I would say insurance is something that should be just proper risk management, like a stop loss that you actually put for your intraday trade at your investment. That is how you should look at a term insurance or an insurance. So ideally, we are not expecting something back from your term insurance policy. Let's assume I'm actually 26-year-old. I have a 1 crore term insurance plan. In that case, I'm only paying 10,000 rupees on an annual premium basis for next 30 years. In that case, my annual premiums totally that I would spend is 3 lakh. The term insurance coverage that I would have built would be 1 crore. So in that case, what you would need to have as a proper base would be at least 10 to 15 times your annual income as a proper term insurance cover. And when you take a term insurance cover also, you need to have something called as critical illness policy or critical illness as a rider to your term insurance cover. Why I would say that having critical illness is also important, apart from having health insurance, is, let's say, for example, most of the aggressive, let's say, illness like cancer, heart surgeries, or tumor surgeries, or something like that, are not covered in a basic health insurance cover. Let's say, for example, if you have a critical illness cover as a rider to your term insurance cover, your premiums are fixed for your lifetime. But in a basic health insurance cover, what happens is, as in how your inflation of medical expenses grows high, your health insurance premium also is going to increase over a period of 5, 6 years and so on. So in that case, once you have critical illness as a rider to your term insurance, it's going to be fixed for a lifetime. And once a person is diagnosed with critical illness, they're going to pay out the entire cover to you in lump sum. Let's say not specifically depend on the medical bill like a specific health insurance would be. And apart from that, disability bill is also, or disability insurance is also something that people can look for. And but main core, I would say, term insurance and health insurance is something that you should surely have, and it should not be a miss out. You can just assume that as a rule of thumb and write it down. So slide 10. So here's going to be one of the interesting silent thieves that people actually ignore. So let's assume if your investment returns are just 8% and inflation runs at 6%, your real return is just, let's say, for example, 2%. Most people plan in nominal numbers, that is 8% growth rate, 12% growth rate, and wonder why the corpus never feels like enough. Look at this. 1 crore today in 25 years will buy you what 23 lakhs buys today. So same number on paper, completely different value, right? So a few reality check. Your fixed income, or let's say fixed deposit, is actually not that safe compared to your growth ways. Let's say, for example, 7% FD growth minus 6% inflation. And let's assume pre-tax of, let's say, for example, 7% minus 6% inflation is just 1% growth rate. And apart from that, let's say, for example, medical inflation, that is the highest, or let's say expensive one. Also, the education inflation is also catching up. It is also running in the same range of 9 to 12%. So hence, in that case, the only option for you is equity. Long term, it's the only asset class that actually can really, let's say, beat the inflation. If you're 100% allocation and fixed income, debts and PPF and everything, you're playing it too safe, but you're playing it actually backwards. And in the stage of, let's say, for example, 30, 40 or 50, when you are in the age of accumulating corpus, you should actually focus on high growth assets and not just more safety or conservative investment style. So we have actually spoken more about, let's say, diagnosing what's actually wrong and what you are actually working against you. Now let's talk about few investment solutions, or let's say few things that actually can help you plan your entire, let's say, for example, investment journey in a very disciplined way and very clever, let's say, for example, way. So in that same thing, there are few things that actually can make it right for you. So before you pick up a single fund, write down 3 to 5 goals that you already have in mind. Specific amount for each of your financial goal. So specific dates also assigned to that. Let's say, for example, it can be children's education. You need 35 lakhs by 2034. Second goal can be retirement. You need 4 crores by 2042. So label each one of this as mid, long, or short term, whatever the time duration being in. So stop investing in anything that doesn't map towards a goal. So if you can't answer what is the money for, and don't invest in that yet. So let's say, for example, if your child's education is just in 1, 2 years, let's say down the line, you should not invest in equity. You should either focus on, let's say, some corporate bond allocation, arbitrage fund, or debt allocation. So based on your time horizon, you need to find out what fund would suit that specific financial goal. Step 2 is going to be decide your asset allocation. So your mix should be anchored to your goal horizon. As I said, if it is short term, you need to have a very conservative investment fund. If it is a medium or short term, then you can look for mixed fund or an equity fund too. So one tip is, let's say, set ranges, not just numbers. Let's say, for example, equity to 50 to 60%, not just, let's say, 60% equity for entire asset allocation. It should be based on a financial goal that you already have. And finally, match the risk that you can take and then find what fund would be suitable for that risk appetite. So all three needs to be lined up. If they don't, your plan won't survive the next, let's say, drawdown or correction. So next step is going to be diversify like you actually mean it. Real diversification is across asset class, equity, debt, gold, real estate, not just across fund houses, across geographies, India and globe also, and across market cap, large, mid and small cap, and also across different investment styles like growth style and value style. So that doesn't mean you need to have diversification in equity, debt, gold at all point of time. you need to enter into that specific asset class when the right time is actually there. Let's say, for example, for our investor base, 3 years back, we did have good decent allocation in precious metals. But let's say next last few months, we stopped further adding up in precious metals because already it has run up and we wanted to participate in high conviction ideas for next 3 years, 5 years perspective. So in this case, the next thing is that I would recommend is step 4, review, rebalance, and repeat. Once a year, sit down with your financial advisor, look at your financial goals, look at your allocation, look at what costs or expenses that you already had, and look at your progress against each of your financial goal. So if your allocation has drifted more than, let's say, for example, what you actually thought of, it's actually really great. You need to see on how you can actually fasten it further. So that's what I would say, step 4. Goals, allocation, diversify, review, boring. Let's say, for example, it would look very boring in, let's say, for example, how you look at it, but it's very effective massively over a long period of time. So in that case, before and after, this would be something that clarity that most of the people actually had after working out with us. Let's say, for example, each of the fund, let's say that they had in the portfolio, they had a specific goal attached to it. So one thing was, let's say, for example, each of our investor also had a goal with amount and investment timelines that they had. What is the time horizon? What is the risk capacity? And also we had annual review logged in for each of the investor base. So this would be the very small tweaks that you need to bring in an investment journey that actually can start working out in your favor over a long period of time. To simplify again and to review it for you guys, it's gonna be simple thing as emergency fund, insurance coverage, and then just assigning simple financial goal for each of your investments and then doing a review continuously on a regular basis. I'm sure that most of you would already know it, but let's say, for example, the starting trouble is what you're looking for. So that is where we are here to handhold you and help you out and clarify any doubts and queries that you have. Thank you all for joining this webinar. Hope it was insightful or helpful. I know it's going to be same thing that we actually address in, but it is, let's say, for example, more with a perspective of few things that actually can make an entire investment journey much better and smooth over a period of time. So thank you all for joining in. Yeah, we'll catch up again.